So this is part two now. This is where we left off. The levered value is the unlevered value of the company, right? Notice this is total value now. So we're looking at the firm value now, right? So it's the levered value of the firm equals the unlevered value plus the interest tax shield. So here's a this company again, and it's from your book, so I'll go over it rather quickly. So they restructured their existing debt and will instead pay $80 million in interest each year for the next 10 years, and then repay the principal of $1.6 million on the debt in the 10th year. So the payments are going to be risk-free. I don't know why they would be, but the company must have a very good bond rating. And the company's tax rate is 25%, corporate tax rate. If the risk-free interest rate is 5%, by how much does the interest tax shield increase the value of DFB? So it's kind of like a net present value problem, right? So the interest tax shield is 25% of $80 million. Is $20 million, right? That's each year now for the next 10 years. Therefore, we can value it as a 10-year annuity, right? It's a 10-year annuity because everything's the same. Because the tax savings are known and not risky, we can discount them at the 5% risk-free rate, right? So that's it. So we treat this as a 10-year annuity. See, 10 years. Here's the 5%. Here's the $20 million. So the 10-year present value is $154 million. You'll notice here, and it's interesting because you notice that the money back is not tax deductible, right? So it doesn't contribute to the tax shield. It's just the $20 million a year over 10 years that's contributing to the tax shield here. So here's another example, very similar. And I guess you can go over that, right? Same deal. This, I believe, is what, over 8 years at 6%. All right, so we're now talking about like permanent debt. So, whoops, before I don't want to mess up here. Typically, the level of the future interest payments is uncertain due to changes in the marginal tax rate. We all know the marginal tax rate always changes, right? In fact, Trump changed it, right? I think he made it 22% or something now, and so currently, so the amount of debt outstanding and the interest rate on that debt and the risk of the firm. So all these things change the interest payments, right? So the marginal rate, the amount of debt, the interest rate on that debt, and the risk of the firm. So for simplicity, we will consider the special case in which all the above variables are constant, right? Nothing changes. It's fixed for, I guess, forever. We'll do that. All right. Suppose a firm borrows debt D and keeps the debt permanently. All right. If it's permanent, you know what that means. You know where we're heading, probably toward a perpetuity, right? So if the marginal tax rate is TC, and if the debt is riskless with a risk-free rate RF, right, then the interest tax shield each year is TC RF times D, right? The tax rate times the risk-free rate times the debt, right? This is the corporate tax rate. Here's the risk-free rate times the debt, right? And the tax shield can be valued as a perpetuity. So this is the risk-free rate for the debt. Okay, so we got three numbers here. So we as you notice, it's forever, so we're gonna make this a perpetuity, right? We'll make that a perpetuity. So that's a perpetuity. So the present value of the interest tax shield is TC times the interest, right? Which is the corporate tax rate times the interest. So that's the tax shield divided by the risk-free rate, because it's a perpetuity, right? It goes on forever. Remember that? So TC times the interest. So what is the interest? The interest is the risk-free rate times the debt, but we have the risk-free rate here, right? So risk-free rate cancels risk-free rate. So the present value of the interest tax shield on a perpetuity is the corporate rate times the debt. That's it. That's, of course, if you use the risk-free rate, right? Well, whatever. All right, so now the debt, if the debt, they say it's fairly priced, no arbitrage, there's no arbitrage. That means that nobody can make a risk-free profit, right? And its market value has to by law equal the present value of the future interest payments. So the market value of the debt, right? D, the current market value has to be the present value of the future interest payments, right? So here's the present value of the interest tax shields. So the market value is D, and that's equal to the present value of the future interest payments, right? And this is with permanent debt. So if the marginal tax rate again is constant, then the present value of the interest tax shield is the present value of the corporate rate times the future interest payments, or you pull TC out, and basically TC times the present value of the future interest payments is, as we just said a minute ago, equal to the current value of the debt, right? The current value of the debt. So the present value of the interest tax shield is TC times D, and I think we saw that a couple slides back, right? And there it is. So we kind of proved that, right? Okay. So with when we're going to talk about the weighted average cost of capital now with taxes. Okay, so we're going to include taxes now. So let's highlight that. The weighted average cost of capital with taxes. So with tax-deductible interest, the effective after-tax borrowing rate, so here's the effective after-tax borrowing rate, and this is just like with your mortgage, right? Everyone who's got a house, they know that it lowers their mortgage payment, right? Because they write off the interest on their mortgage, right? You used to be able to write all of it off, but now it's what? It's limited to $10,000, I believe. And the weighted average cost of capital becomes, so the weighted average cost of capital takes into account the equity and the debt, and this is after tax. Okay, you see this after tax here. Okay, so it's the equity over the equity plus the debt times your required return on the equity plus the debt over the equity plus the debt times, right, the rate on your debt, right, your required return on your debt, all minus 1 minus the corporate tax rate, because it's all after taxes. So this is your weighted average cost of capital equation with taxes, right? And so this is all after taxes. You see, weighted average cost of capital. All right, so if you break this down and you solve this, you'll have the pre-tax weighted average cost of capital here, right? This is the pre-tax weighted average cost of capital, right? Because we got this and we got this here with an RD, right? So this is all, notice this is all pre-tax. And then you subtract off, this is the portion, this is the reduction due to the interest tax shield, okay? So you've got D over E plus D times RD times TC, and it's negative. So this is you notice how this portion here works out to reduce your weighted average cost of capital, okay? So, all right, so here's the weighted average cost of capital with and without corporate taxes. So here's your weighted average cost of capital with taxes, right? That's what we just solved. And as the debt financing goes up, you'll notice your cost of capital drops off, right? And here's your unlevered pre-tax, right? This is unlevered before the taxes kick in. You notice that's flat. All right. So here's your after-tax debt cost of capital. This is the portion. So this is the portion here that begins to pull this down. Everyone see that? So here's your debt cost of capital. And here's your after-tax debt cost of capital. You notice this is lower than that, right? So this portion tends to pull your weighted average cost of capital down, right? Even though your equity cost of capital goes up here, right? So you notice your equity cost of capital going up here, right? So companies will adjust their leverage, okay? And this is now you're looking at a target debt equity ratio here. So they'll adjust their leverage to maintain a target debt equity ratio, and you can compute that, right, with leverage by just discounting the free cash flows using the weighted average cost of capital. Okay, so so you can do that. So the value of the interest tax yield can be found by comparing the value of the levered firm, right, with debt, right, and with interest payments, to the unlevered firm of the free cash flow discounted at the firm's unlevered cost of capital, the pre-tax weighted average cost. So this is the pre-tax weighted average cost of capital, right? So the value of the interest tax yield they're saying you can look at both of these, right? So you compare the levered and the unlevered. All right, so let's go through this example here. So we're going to look at an interest tax year with a target debt equity ratio. So Western Lumber Company expects to have free cash flow in the coming year. So here's their free cash flow. This is the money left after all debts have been paid, right? So, and its free cash flow is expected to grow at a rate of 4% per year thereafter. Western Lumber has an equity cost of capital of 10% and a debt cost of capital of 6%. And it pays a corporate tax rate of 21%. They want to maintain a debt equity ratio all the time of 50%. Always want debt to equity to be 50. So what's the value of the interest tax yield? Okay. So remember, debt to equity has always got to be 50%. All right, so here's the equation for the pre-tax weighted average cost of capital, right? We estimate the value of the interest tax yield by comparing its value, and here it is with and without leverage, all right? So we're going to get the, this is the pre-tax weighted average cost. There's no leverage here. Everyone see that? So you'll notice here that here's the return, here's the capital return on equity. Here's your cost of capital on debt. And here's the equation, equity over equity plus debt, and debt over equity plus debt, okay? So we know this is 10%, and we know this is 6%, right? So we know the debt to equity ratio is 0.5, right? So remember, it said debt to equity is 0.5 ratio. So this is 1, this is 1, this is 0.5, and this is 0.5, and this is 1, and this is 0.5. See that? Okay. Now the free cash flow. So this gives us your weighted average cost of capital, and that's 8.67%, right? So this is goes on forever, and it's at a constant rate, and it's a constant growth perpetuity, right? You notice that? It's a constant growth perpetuity here. Everyone see that? So the unlevered, now we're doing the unlevered first. The unlevered value of the firm, all right, unlevered, right? There was no interest on debt or anything. Here's the constant cash flows. Here's the 8.67 we calculated, and here's the 4% growth. Right, now we got to calculate the weighted average cost of capital on the levered company, all right? So we got to do that on the levered company. All right, so now here we are now with the levered equation. You see this little portion right here? Now, all these numbers pretty much stay the same, right? All these numbers stay the same. And all you do is add the tax rate here, right? And now this weighted average cost of capital comes out to 8.25, which is lower, right? With the interest tax shield. So you put that there, and the value of the company now is 100. So what's the value of the interest tax shield between the levered and the unlevered, right? And actually, it should say this. It says positive here, but it should be right negative, right? You're subtracting. So the value of the levered right here minus the value of the unlevered is 9 million. So that should be a negative, right? So it's that simple. What's the value of your interest tax shield on a perpetuity if you have a constant debt equity ratio? All right. So I'm about 17 minutes into this piece here. So I'll upload this piece.